Something unusual is happening in America right now. The Federal Reserve just made a decision, and millions of people may not realize what it could mean for their money. Mortgage payments, credit cards, savings, investments, jobs. All of them can be affected. And today, we're breaking down exactly what happened. No complicated finance language, no confusing charts, just simple explanations. Because this could impact almost every American. Let's begin. First, what actually happened? The Federal Reserve decided to keep interest rates unchanged. At first, that sounds boring. Nothing changed, right? Not exactly, because markets don't only care about what the Fed does today. They care about what the Fed says about tomorrow. And the message investors heard was simple. The fight against inflation may not be over. That's the warning. Now, if you've never understood the Federal Reserve before, here's the easiest way to think about it. The Fed is like the temperature control system of the US economy. If the economy gets too hot, prices rise, inflation increases. The Fed tries to cool things down. If the economy becomes too slow, the Fed tries to stimulate growth. And their biggest tool is interest rates. But why do interest rates matter so much? Because money becomes more expensive. Imagine you want a house. Higher rates mean bigger monthly payments. Imagine using a credit card. Higher rates mean more interest. Imagine running a business. Loans cost more. That's why one decision can impact millions of people. Now let's talk about inflation. Inflation simply means prices rising. Food, gas, rent, services. Everything becomes more expensive. When inflation stays high, the Fed usually wants people and businesses to slow spending. One way to do that is keeping rates higher. But here's the problem. High rates also create pressure. Companies may hire slower, consumers may spend less, growth may slow down, and that creates a difficult balancing act. That's why investors watch every single word from the Fed, because one sentence can move billions of dollars. Now, let's talk about how this affects normal people. If rates stay high, buying homes may remain expensive. Car loans may stay costly. Credit cards may remain painful. Businesses may become cautious. But there's another side. People keeping cash in savings accounts may earn more, so there are winners and losers. Now let's talk about the stock market. Stocks react because companies react. If investors think rates stay high, markets may become nervous. If investors think lower rates are coming, markets often become optimistic. Technology stocks, banks, consumer companies. Everyone watches the Fed, and this is why headlines explode after every Fed decision. But here's the biggest question. What happens next? Nobody knows. Not analysts, not investors, not social media experts. Because the future depends on inflation, jobs, consumer spending, and economic growth. Everything can change. That's why smart investors focus on understanding, not predicting, because long-term decisions usually beat emotional reactions. So what's the real warning? The Fed is signaling that borrowing may not get easier immediately, and Americans may need to prepare for an economy that stays expensive longer than expected. Whether you invest, save, or just buy groceries, this matters. Now, tell us in the comments, do you think rates should go lower or stay high? Subscribe for more finance videos explained simply, and we'll see you in the next one.